Africa is full of amazing business opportunities, but without capital, most businesses cannot get off the ground. As a result, there are thousands of passionate people across Africa who cannot grow their business ideas and projects because they don't have access to the right institutional investors. Now, a lack of capital is one of the biggest threats to entrepreneurs across the world, especially in tough business environments like Africa. In fact, most people will say it's hard and almost impossible for entrepreneurs to raise capital on the continent, especially if you're a startup, because no one wants to invest in businesses on the continent, basically. How true is this? Well, joining us this morning for context are co-publishers of a white paper titled Chasing Outliers: Why Context Matters for Early Stage Investing in Africa, Chen and Osarumen Osamuyi. Thank you for joining us on the morning show. I'll start with you now, Chen. Let's ask what approaches to institutional investment you propose for the continent.
Yes, I think there's a wide range of different kinds of approaches. And unfortunately, to this point so far, the venture capital approach has been the one that's most talked about, that has produced the most flashy success, and maybe in Silicon Valley. But we need to look broader and beyond just that approach to find success on the continent.
All right, Tony, I'll keep you on pause. Let's talk to Osarumen now. Osarumen, glad to have you join us. Well, some are of the view that it's hard, almost impossible, that's the phrase, for entrepreneurs to raise capital in the African continent. But this really is not akin to Africa, or is it? And if it is, why is it so?
I think it depends a lot on the type of capital. So it's much easier, for example, to raise impact-focused capital on the continent than it is to raise from purely equity, purely for-profit investors. And one of the reasons why that is that this is still an early emerging ecosystem. And so it's an emerging ecosystem. And so we have not yet shown, I guess, the level of development, or we've not yet shown the commercial potential that exists within the industry.
Well, how do we get about showing that?
Well, the most popular would be through exits. So when specifically technology companies or technology-focused companies raise venture capital, the typical path is for them to grow really large and have outsized influence, and at some point either get acquired or go public. Those are the two most popular ways that the early investors then get more liquidity. And that early activity then drives more investment in the ecosystem. That's what actually causes capital to begin to flow in massively. And we're beginning to see that happening already on the continent. I think pretty much over the past decade, year over year, you've seen significant increases in the amount of capital invested from externally into the continent.
And Tony, on what evidence do you base your assertion that there exists a wide misalignment between traditional venture capital financing models and the African continent one?
Yeah, Osarumen, Tayo, and I, we spent the last year and a half basically interviewing 100 investors, entrepreneurs, and limited partners who invest on the continent across 15 African nations, and collected their feedback, took 900 pages of notes and identified the themes coming out of those interviews. And the wide consensus was that the Silicon Valley venture capital model has all these assumptions that's hidden underneath. For example, that you have to have really huge markets, that you have to be able to capture customers very cheaply, that there's investors at every stage to fuel your growth. If a lot of those things aren't actually true in many of the markets, then why are we still chasing this model, exclusively, when we can look at other types of models as well?
All right, so you now, Osarumen, from your report, you're suggesting that investors should prioritize investing structures and practices that reflect the realities of operating in Africa. One question will be, what indeed are these realities that you're talking about? And then the second one will be, how do you now tailor investing structures and practices to reflect these realities?
Thank you for that. I think, venture capital as currently constituted was developed. It's a good fit for a very specific kind of business, for the kind of business that you can invest relatively large amount of money.
I'm not interrupting you, Osarumen. Can we break down for purposes of understanding? I think you talked about two kinds of venture capital before you eventually go into this question. What is really venture capital? And the other capital you talked about that I can't remember now, but you remember it.
The African market.
So venture capital, okay. So when the biggest technology companies that exist today, when they were just getting started, they were often, a couple of programmers in a garage or something. That's the stereotypical view of what a startup is. And they often needed money to invest upfront to develop the product, because software products specifically, when you invest upfront and you actually you tap into latent demand, that is, you find a market opportunity that is real. The businesses can grow so large compared to the amount of money that was invested in them. So, for example, if you invested in Facebook in 2004, perhaps you may have thought that was an expensive investment, but over time, you see that Facebook has grown to an $800 billion company. So specifically software companies, internet companies have the potential to grow so large relative to the amount of investment made. And venture capitalists are effectively like high-risk, high-reward investors who try to find these companies and invest in those that they think will become those huge companies, I guess, in the future. And then, crucially, it's expected that most of the money invested in that manner will be lost in those companies. But when you do get a really big win, you can imagine investing in a company that was valued at $5 million when you made the investment, and 10 years down the line, they're at $800 billion. It almost doesn't matter what else you invested in, because the winnings from that investment will pay for everything else.
Yeah, so continue with the major question about prioritizing investing structures and practices that reflect the realities of operating in Africa. If you remember that question, what are these realities? And then, of course, how do you tailor investing structures and practices to reflect these realities?
Yes. So in the first case, again, back to the example I gave, that specific quality of software businesses assumes that the market for the product you're selling is effectively global, it's effectively unbounded. Again, it costs Facebook nothing to serve an additional customer, to have one person create an account and begin to use it. But, Facebook is going to generate, multiple dollars of revenue from that specific customer. What we found is that as venture capital, started in Silicon Valley and got exported around the world, it went from a global market effectively to increasingly regional markets. So the kinds of technology companies that you find, in Africa, for example, or in Latin America or Southeast Asia, are often solving really hard local problems that just make the companies just that much more difficult to scale. So again, if you are fixing logistics in Nigeria, that's a really hard problem that you perhaps raise a lot of money for and spend many years trying to solve that problem, fix different points of the value chain. That's a very different business from, say, a Facebook or a Spotify or a Twitter. One internet company that effectively scales, within 5 years from $0 to $100 billion. So because the effective market size is smaller right now, making investments with the assumption that you have a big winner that will pay for everything else doesn't make too much sense. That's the biggest, driver of the mismatch. The other thing is, when people talk about technology markets, they talk about, say, India, which is a country, talk about China, which is a country, and then they talk about Africa, which is a continent with 54 countries. And that significant fragmentation, again, also means that if you invest in a company starting out of Nigeria, there's significant friction for them getting set up and building a robust business in Kenya, in South Africa, in Cote d'Ivoire, and across the continent. But and the opportunity is continent-wide.
Okay, so let's ask you, Tony, now. Another challenge that you mentioned in your report is that consumers on the continent are difficult to acquire and retain. Why is that so?
Well, a lot of the research pointed at the fact that many consumers, African consumers, are very price sensitive and utility sensitive. So obviously price matters a lot. And if there's any friction around getting the product itself or any customer service issues, they're very quick to jump to the other side. So that's one thing. Secondly, in America, you might have a product that you can easily roll out very quickly because the infrastructure, the roads, the internet service, even in rural areas, you can just roll out so quickly. So a lot of those foundational infrastructural issues are still problems that need to be solved in many cases. So without solving those, it's harder to reach that scale of customers in all these fragmented markets like Osarumen already mentioned.
And then retain them. Tony, I'm going to stay with you. Talking about, retaining, acquiring, and retaining. The question will be, the challenge will be, how do you turn this situation around?
Well, I think the situation is turning around. Osarumen actually recently wrote a great article about how comparing the different ecosystems in Africa to, let's say, Latin America or other Asian ecosystems. And you're starting to see that, a great line in there just says ecosystems develop slowly and then all at once. So as you start to see some of the successes coming out of Africa, I mean, we've seen more and more successes even in the last 18 months. You've seen the big, funding rounds and exits for like InterSwitch and Andela and others. And you're going to see more and more of those. And as those get going, that people will begin to realize there is great potential, but it takes digging deeper into the problems and more local nuance.
And let's ask Osarumen Osamuyi now. How should investors prioritize structures and practices?
Do you mind adding some color to that question?
The question is, how should investors prioritize structures and practices, especially in investing that reflect the realities of operating on the continent, that is?
Okay, got it. Well, I think it's a couple of things. I think it makes sense to first start from analyze the market as it is, as it exists today. And one other thing to consider is, what stage the investor is coming in. So a very early stage investor, for example, might be able to play the VC game, a bit more than a later stage investor might in this market. So I think the fundamental step is, I guess, mapping out exactly what markets within Africa are you investing in, what kinds of companies are you investing in, and then working backwards from there to say, okay, so if I think the company I'm investing in right now at this stage is going to go on to raise $2 million and is going to raise $7 million, and we can roughly expect exit value to be $50 million based on XYZ signals, then it makes sense to come in at this price. It makes sense to have these kinds of companies in my portfolio, that's portfolio construction. And then you also think about, balancing risk geographically, etc. So it's basically, I guess, on the foundational level, working backwards from the market realities and then developing structures that fit your unique situation, that fit the specific kinds of companies that you're trying to invest in and the trajectories you envision for them.
All right, Tony, on this program, sometime we discussed with a CEO of a company, and he talked about fragmentation. And this issue of fragmentation is coming up again in your report. Help us understand what we really mean when we talk about the African market being fragmented, as it were. And then, is that an advantage, Tony, or a disadvantage or a problem that can be turned into an opportunity? And if it is, how?
Yeah, that's a great question. I think one of the interviewees that we talked to basically said that Africa has great potential, not despite the challenges, but because of the challenges. So if you look at the fragmentation again of the markets, where if I talked to all these entrepreneurs in Kenya, and now they're trying to figure out how to operate in Tanzania and Uganda and Nigeria, and the friction of setting that up. And let's say you're a fintech, now you got to deal with different governments at all these different levels. But if you are a fintech working in these different markets and you do get the coveted licenses to operate, that then becomes an advantage as well. So the fragmentation is kind of a barrier to entry, if you will. It makes it harder to operate in general. But once you get past those, that becomes an advantage for you as a company to grow and really do some business in the market.
I actually wanted to, I don't want to take things for granted. So I want us to better appreciate or understand, if you like, when you talk fragmentation of the African market, what do we really mean? I don't want to leave it at the point of being pedantic, you know. Let's break it down, because you didn't break it down for me. You talked about the other questions, but you didn't break down when we talk about African markets being fragmented. What are we really saying?
I would say that Africa is the most diverse continent on the planet. Culturally, ethnically, linguistically, and scientists even say genetically. So, and it's not just diversity between countries. We're talking about diversity within countries, right? So if you look at the 20 most diverse countries on the planet, guess where they are? They're all in Africa. So that in and of itself begins to talk to, like even in Kenya, the market that I'm most familiar with, when you have the 40-something tribes, you know, so I mean, you can't necessarily say that everything, whatever you're producing is going to work for everyone, right? So that's really the fragmentation comes from culture. It comes from government lines and regulations. And I think those would be the two key points of fragmentation.
No, I guess it. No, I guess it.
Okay, Osarumen, now let's ask you that. Now, one of your recommendations is considering non-unicorn investing models geared at more resilient companies. What exactly do you mean by that?
Well, it means that if you assume that, at least for some time in the short term, the biggest successes in the market are, might be exit for around 200 million, for example, as we saw Paystack just did to Stripe, then your investing practices effectively have to reflect that reality. You have to basically, again, work backwards from saying, if an exit for me looks like $100 million acquisition, how do I need to invest today? I guess that I end up making money in that world. Because if you invested, for example, $10,000 each in 50 companies, and then one of them ended up exiting for $200 million, like at the level of your fund, you're likely not to have actually made any money, even though that deal went great. But the question, in my perspective, is, do you get to put, I guess, enough capital in the right companies, in the few companies that will reach that scale? Do you have enough ownership in those companies by the time they're exiting that you end up making money at the portfolio level? I think that's the most fundamental thing.
All right, to you now, Tony, at the risk of, I don't know whether it was you, or I guess it was you, of repeating yourself, let's dissect what you have called multiple mismatches between key characteristics of the Silicon Valley and African markets. You said they influence how startups and funds maneuver and the results they expect to produce. Let's, like I said, at the risk of probably repeating yourself, I don't know, let's dissect it.
Right. So the mismatches are many. The first is that Silicon Valley venture capital models assume, like Osarumen said, global, huge, big markets, and that you can capture customers at almost no extra cost, like adding another user for Facebook or whatever the software service is that you're trying to add. So huge markets, cheap to acquire customers. You have investors at every stage. So, in the US, you have people lining up to do seed funding, Series A, Series B, Series C, all the way until IPO. You have people chomping at the bit trying to get into your business at every stage. And that none of those things are true in most African markets. And actually, I will say in most markets globally. So even if you look at venture capital in Europe, there is not a lot of what they call, these unicorns, quote unquote unicorns, who reach a $1 billion valuation, which is kind of the mythical creature, the mythical company that everyone's trying to capture. There are not that many of them because Europe, in a way, is similar to Africa in the sense that the countries, are more fragmented, and the markets, each one, tend to be, slightly smaller. So the math just doesn't work out. So when we talk about, you invest in 10 companies as a venture capital firm, and if one of them hits really big, right? If one of them 100x's, then the other 9, if you lost all your money on the other 9, it doesn't matter. Well, if the winners in Africa don't get that big, then you can't just win 1 out of 10. You maybe have to win 3 or 4 or 5 out of 10 in order for the fund to work to return the money back to the investors.
Tony Chen, let's look away from this report you co-published with Osarumen now. You're the managing director of Kenyangu Ventures. Tell us how you have been catalyst for early to growth state businesses.
Yeah, so I've spent 20 years starting businesses, and I found myself in Kenya, living there for 3 years. As an entrepreneur at heart, I just hung out with entrepreneurs, and 300 coffees later, I found some entrepreneurs that I really believed in, but didn't have access to great capital. So, just as a entrepreneur trying to solve a problem, how do you get the right capital to the right companies in the right way? That is really the genesis of Kenyangu Ventures. And so we've done, we did 8 investments last year in Kenya, tech companies, agriculture companies, media companies, services businesses, and all kinds of instruments, debt, equity, convertible note, those kinds of things. And it's just a matter of walking alongside these entrepreneurs at the very early stages of their business to try to provide capital. Sometimes capital is the most important thing, but many times it is also connections, context, wisdom, the right advice at the right time, or the right connection at the right time is sometimes more valuable than, $100,000. So trying to provide all of those things.
Absolutely, Tony. Connection is key. Who you know takes you to where you want to get to. But let me stay with you. Yeah, that's true. Let me stay with you. You were talking about Kenya. Here you are discussing with me and my colleague in Nigeria. You set up 7 or so in Kenya. How many have you set up here?
Yeah, in Nigeria.
Still working on the first one in Nigeria. But, for me, I go wherever my trusted network takes me, because like you said, it is all about who you know and who you can trust. And as I get to know more people like Osarumen, I think I'm going to be pretty excited about Nigeria. Yeah,
Nigeria is pretty a good place to be excited about because, after all, we're the biggest economy in Africa. The biggest black nation. So, you are in the right place. So you better get going, really. Yeah. Yeah, Fadi.
Thank you.
Well, Tony, what do you think the prospects are for businesses on the continent in the state of COVID recovery?
Yeah, I think it's tough all across the world, especially the ones that are more services related. But at least my experience in Kenya has shown that the resilient businesses are going to get through this. And in a weird way, COVID has sort of uncovered the weaker competitors at times. And maybe now the more resilient, stronger businesses are coming out stronger with less competitors. So there's still plenty of opportunity. There's still plenty of innovation to be done. There's still plenty of problems to solve. So I'm very, very bullish around the future. And if you look at venture capital funding, even in 2020, in the midst of COVID, it basically remained flat on the continent, something like $2 billion or so based on the recent reports. So funding is still coming and people are still solving problems. So let's keep going.
We keep going and people will continue to solve problems. Osarumen, African markets, Osarumen, to you, African markets are large. Will it be right to say that African market also presents a real opportunity for profit once the environment is clearly understood? Will it be right to say that? And what then is the key to understanding this market?
To the first question, I think it's absolutely right. I think that, it's said very often, but I think we need to say it even more, that there is 1 billion consumers on the African continent, and those consumers are going to have needs that technology companies specifically, can serve. And crucially, many of those companies will provide tools, for economic prosperity for those 1 billion people. And I think that opportunity is absolutely exciting. To your second question, what we've seen is, the ecosystem or the entire startup community or the technology industry learns, as a hive mind. So in 2012, for example, there were certain kinds of businesses being, founded in Nigeria, assuming certain things about the market. Assuming, for example, that you could take cars, list them on a website, and that was enough to create significant value, or list hotels on a website, and that was enough to create significant value. What we're finding is some of the pieces of infrastructure that exist in other markets, that exist, for example, in the US, that make Amazon work, may not exist here right now. And so the next generation of entrepreneurs will incorporate those learnings from, some of the mistakes that the early businesses made. And then the cycle goes on and on. And I believe that that's what actually drives the increase in value. So it's the reason why the technology companies being built today are so much better funded and have grown actually quite a bit larger than those founded a decade ago, is that the entrepreneurship community has figured out the contours of the market. That's my view. I don't think there's any, you can't sit down and say this is a top-down view. We're going to understand how Africa operates. I think entrepreneurs themselves, by grinding at the problems and opportunities on a day-to-day basis, will discover where the contours are. We'll discover where there's actual opportunity, where you can actually build a robust business, etc.
All right, they've been speaking to us on raising startup capital in Africa. Tony, Chen and Osarumen Osamuyi would like to thank you for joining us on The Morning Show.